Okay, so we're here to start the live session. Thank you for joining, Ada, Kunita, and Karian. Today we're discussing the sample questions that you can expect in your final coming exam that starts tomorrow. It's going to be open for a week, and you can attempt it anytime. We will be using lockdown browser, so be ready for that as well. And here I've got only one attempt, 120 minutes, and is per your recommendation in the last exam, where some students complained that it was a bit too lengthy, so I have reduced the number of questions so that you can have enough time to attempt the questions. Now, these problems that we're going through, there are going to be some true, false, and those kinds of questions as well. But I think that will be coming from your text. We're going through some problems, and these will be kind of similar to what you can expect in the exam. The problems would be given in description, so you would have to read the description and extract the data and then find the solution. What I've done here for saving some time and going through it a bit more quickly, I have just created problems and extracted the variables for you so that we can quickly go through this. Now, these problems can be solved through your using your calculator. And you can also use Excel that I have embedded in Lockdown browser. So it's up to you. I'm going to use Excel, but if you want me to show you something using a calculator, we can do that as well. But most of these problems are, simple, math or algebra problems, so it's not going to be a big deal. Okay, now let's get started. Question 1 or problem 1, calculating expected rate of return. So you'll be given problems where the problem states that there are different probabilities of the economic situations that a company can face. The economy can be good, bad, or just normal, and what will be the possibilities, the probabilities in those cases, and what will be the return if in that particular probability or that particular economic situation. So let's say that there is a probability, a chance or probability, that's the same thing. If the problem states chance, that's the same thing as probability. So there's a 30% probability that we will get a return of 40% on our investment. So this might be a new project and probably will get a 40% return, but the probability is 30%. There's a 45% chance that we will get a 15% return. And there's a 25% probability that we may get negative 30% return. So in that case, in the last probability, we'll be losing money. The question would ask you to calculate the expected rate of return. So what would you expect when we combine these different scenarios? So you will be calculating only the expected rate of return, but in order to do that, I have highlighted the required thing here in this kind of, what is it, blue color, or what is it anyway? But in order to do this, you will have to calculate these yellow cells as well. Now, how are we going to do this? Calculating the expected rate of return, we have to multiply the probability with the return associated with that probability, and then the second probability with that return. So I have written that here in this column, that is P into R, probability multiplied by the return. And when we calculate these multiplications, these products, we will then sum them up, and that will be the expected rate of return. So let's do that. I'm going to write an equal and then probability multiplied by the return associated with that probability, which is 40% in this case, in enter. So that is 12%. I can drag this down. If you're using Excel, that becomes easier. So it automatically multiplies the probability with the return. So when I did all of these, then I can find the sum of all of these values. So that will be equal to sum of these values. And the expected rate of return in that case is 11.25%. All right. That's your answer in this case. Any question?
Okay, I have that one.
Okay. Now let's move on to the next one. If you are not clear, just raise your hand, ask me. Just ask me. I may not be paying attention to the raised hands as I'm focusing on the problems here. Just jump in and ask me. Now, the next question is about a portfolio. Okay. And we are required to calculate the beta of a portfolio. Beta of a portfolio basically means the risk of the portfolio. What we mean by a portfolio, it's a combination, it's a mix of different investments. So you have invested some money in stock and some money in bonds and some money in, in cryptos. And so you have created a portfolio, and these different components of the portfolio have different risks, and you have invested different amounts of capital in the portfolio. So in this particular case, we have two assets, two stocks, A and B, and we have invested 100,000 in stock A and 200,000 in stock B. The total investment we have made is 300,000. The beta of stock A is 0.75 and stock B is 1.75. These are basically the riskiness of these assets. So if the beta is less than 1, that means this asset is less risky as compared to the market. And if it is more than 1, that means it is more risky as compared to the market. But more risky means you get more return. Okay. That's the data given here. We are required to calculate only this thing, which is the beta of the portfolio. So how do we calculate the beta of the portfolio? The formula for that is beta of the portfolio is equal to weight of asset A multiplied by beta of asset A. So we have to calculate. Now we don't have weight given in this equation. So first we need to find the weights. We'll have to find the weights first. And then plus the weight of asset B multiplied by the beta of asset B. And if we have another asset, we will find the weight of that and multiplied by the beta. And if we have a third, fourth, fifth, whatever number of assets we have, we'll have to do those multiplications. Okay, so this is not, but what we have to find, we have to find the weight of these assets. So how do we, what do we mean by the weight? Weight basically means like what is the percentage of that particular asset in our portfolio. So our total portfolio is 300,000. And asset A has got 100,000. That means 1/3 of our portfolio is in asset A. So that 1/3 or 33% is basically the weight of asset A. And similarly, we will do this one. How do we calculate this weight? That can be basically done by making this equal to, we take the investment in asset A and divide it by the total investment, which is 300,000. That will give me the weight of asset A, which comes out to be 33%, as you can see, right? And if I multiply the next one too, that will give me, this has to be, let me do that individually. 200,000 is the investment in B, and then divided by the total investment, which is 300,000. So that weight is about 67%. Okay, the total weight must be equal to 100% or 1. So I can do it equals to this weight plus this weight. That is not required. for the problem, but just to make sure that we get a 1 here, we just to make sure. Now, we need to multiply the weight of the asset with the beta of the asset. So weight of the asset we just calculated, and the beta of the asset is already given. So we will multiply these two numbers and these two numbers. And when we have those those multiplied, then we add them together as per this formula, and we get our answer. So let's multiply the two. Equals to weight of the asset multiplied by the beta of the asset, which is 0.75 in this case. When I do that, it comes out to be 0.25, and then I do the next one as well. All right, and then this will be equal to the sum of these two, so I can drag this down basically, and that will give me the total beta of the portfolio. Does it make sense?
Dr. Shakur, would you do that one more time with the beta, getting the entire beta, the 0.25 and all that, the bottom one?
This one. Okay.
Yes.
Okay, so it's simply multiplying, as you can see in the formula over here. What I do, if you look at the formula, it says weight of the asset A multiplied by beta of the asset A. So that's what I'm doing. This is equal to weight of the asset A, which is 0.333, multiplied by the beta of the asset A. So I just did that, and that comes out to be 0.25. And then you can do the same over here. Equals to weight of the asset B multiplied by the beta of asset B, and I got this. When I have this, like this is the first part of the problem, of the formula, weight of asset A multiplied by beta of asset A, and then I also calculated weight of asset B multiplied by beta of asset B. So then I add them up as per the formula. So when I add them up, it comes out to be
Okay.
0.25 plus 1.19, and that comes out to be 1.44.
Okay, I got it.
All right. Okay. So that's that kind of problem. So you can expect similar problems. Now, in some problems, these weights would be given to you directly. So you won't have to calculate the weights. But if you're not given the weights, like you're given the investments, total investments on those assets, then you will have to find the total investment, sum them up together to find the total investment, and then we'll have to find the weights as we did over here. But if the weights are given in the problem, then you don't have to calculate the weights. Sometimes it will say, like, you've got 100,000 portfolio, 50,000 is invested in one and 50,000 in the other. Now, in that case, it's pretty easy to calculate. 50% of the weight is asset A and 50% is B. If your total investment are 100,000 and 30,000 invested in A and 70,000 invested in B, so that obviously is 30% weight goes to A and 70% weight goes to B. That is like pretty obvious. But in case these are some, like, big numbers, other numbers, then you may have to find the total of the investment and then find the weights as we did over here. Okay, now another question would be, by how much will the portfolio beta change if we replace stock A with another stock that has a beta of 1.3? Okay, so that could be the problem. We already calculated the beta of the portfolio, which is 1.44. So 1.44 is the beta of the existing portfolio. Now they're saying that we are going to replace asset A with another asset. And the only change that we have is that the beta of the new asset is 1.3. Okay, so we simply, what we need to do is to just replace the beta of asset A with the new beta, so 1.3, and we see what is the new portfolio beta. That comes out to be 1.63. Now the question is, by how much will the portfolio change So of course you find the difference. That would be the new beta minus the current beta. So that comes out to be 0.19. So that is the value by which the portfolio beta will change. Clear? Just in case the question is something like this. All right. Now, next type of question would be calculating the cost of equity using the CAPM equation. Now, this is the CAPM equation that you also used in your case 2 analysis. If you can recall, you had to calculate the cost of equity, which was not given in the problem, and you used this formula, RF, which is the risk-free rate plus beta, multiplied by RM minus RF. And basically the RM minus RF is the market risk premium. That difference between the market return and the risk-free rate is the market risk premium. So sometimes you are given the market risk premium, so you don't have to find the difference RM minus RF. You don't have to do that. But if the market risk premium is not given, and instead you are given the market return and the risk-free rate, then you will have to calculate the difference as well. Okay. Now, in this particular problem, we have a beta of 1.3. The risk-free rate, which is the rate of return on government securities, government bonds, that is 3%. The market return is 9%, and market return basically means like the overall return of the whole market. Like, for example, the S&P 500. That would be the market return. And we compare that with our particular asset or company that we are investing in. Okay. Then how do we calculate the cost of equity? The formula is given right here. So I just create that formula. What is it? RF, which is the risk-free rate, and that is 3%. Clear? And then there's a plus in the formula. Then we take the beta, which is 1.3. And we multiply this parenthesis start, that is RM, which is the market return. Market return is 9%, minus the risk-free rate, which is 3%. And then we close the parenthesis and find the value. So that comes out to be 10.8%. Okay. Now, cost of equity if market risk premium is given, like, the market return is not given to you, but instead you get the market risk premium, which is MRP. So in that case, and we know that MRP is RM minus RF. Okay, so let's just do that and just imagine that this is given. So RM, which is the market return, 9%, minus RF, which is 3%, and that comes out to be 6%. Now, if you are given this market risk premium and you are asked to calculate the cost of equity, then we use, instead of RM minus RF doing that, we just simply give it the value of the MRP. So let's do that. Equals to RF, okay? Or let me just write the formula for you. In that case, the formula would be equal to RF plus beta, RF plus beta into, and instead of RM minus RF, I just write market risk premium. Okay, because that difference is the market risk premium. So we construct this equals to RF, which is 3%, plus beta, which is 1.3, and multiplied by MRP, which is market risk premium, 6%. I do that, and I get the same answer as I got with the previous formula. It's just that in one case, the information is given in one way, and in the other case, you might be given just the market risk premium instead of the market return. So you can calculate the cost of equity using that formula. Make sense? If any problem, just let me know.
Yes, I understand.
Thank you. All right, now the next type of question that you can expect.
I have something.
Oh, sure, Carol.
It's going to be exactly like this on the exam?
No, it's not going to be exactly like this. But if you understand this, and if you can do this, and if you can do some variations of this problem, let's say we change the data, the description of the problem would be like, you'll have to read that and extract the data. So if
Okay.
you understand this, you will be pretty good in the exam. That's what I mean. But it's not like it's not going to be exactly this. You will have variations of the problems.
Okay.
And I'm just talking about the different variations that you can expect. But
Okay.
just to let you know is that if you understand this and you practice it, like before taking the exam, just do a variety of problems using this kind of information before taking the exam, and you would be good then.
Okay.
All right. Okay, now the next question is to calculate the cost of equity using the discounted cash flow approach. Okay, now you may be given a problem where it says that the next dividend of the company is, like in this particular case, it's going to be $0.8 or 80 cents. Okay, the current price of the stock, which we call P0, that is 32.5, for example. And the constant growth, dividend growth, is 8%. All right, this information is given to you, and they ask you to calculate the RS, or the cost of equity, using this formula. Okay, now you may recall that the primary formula that we have in that chapter for calculating the price of a stock, that is equal to that is this formula, which is basically P0, which is the current price of the stock, is equal to D1, and that D1 basically means the next expected dividend, divided by bracket start RS, which is the cost of equity, minus G, which is the constant growth rate. So if you are required to calculate the price, the current price, you can use this formula. Okay, if you are required to calculate the cost of equity, then you simply have to rearrange this formula and find RS. So if I rearrange the formula for RS, that comes out to be D1 divided by P0. D1 is next dividend, P0 is the current price, and plus the growth rate. Do you want me to rearrange this formula for you, or that would be an easy thing to do?
Can you rearrange it, please?
Let me do that for you. Okay. So the formula is something like this. P0, which is the current price of the stock at time 0, that is equal to D1 divided by RS, which is the cost of equity, minus G. By the way, can you see my screen? The writing that I'm doing?
No, we cannot see
No.
it. We can see your screen, but not the writing.
Oh, okay. Let me. Oh, we have Vivian and Angela. Okay, good. Thank you for joining. Yeah, let me.
Thank you.
Oh, you're always welcome. I just want you guys to succeed. So here's the formula for finding the current price. Just in case there's a problem which asks you to find the current price of the stock, then you're going to use this formula. D1 is basically the next dividend. And you're told that the dividend grows at a constant rate of G. That G may be whatever. So if we have to calculate RS, then we can rearrange this formula. What we can do, this RS goes to that side of the equation, and this P0 goes to the division on the other side of the equation. So it's simple arithmetic. That comes out to be RS minus G is equal to D1 divided by P0. That P0 goes to the other side of the equation, right? Now we are required to calculate RS. So RS would be equal to that G goes to the other side of the equation. So it will come look like this, D1 divided by P0. The G is minus on this side. When it goes to the other side, it becomes a plus G. So that's it. We'll put these values in the formula and we get our answer. D1, remember, that's the next year's dividend. P0 is the current price and G is the constant growth. Okay. So let's go to Excel and find the cost of equity, which is RS, and we just found the formula. And the formula we just derived is RS is equal to D1 divided by P0 plus G. So let's do it. Equals to D1, which is given as 0.8, divided by P0, which is 32.5. Okay, and then plus the constant growth, which is 8%. We do that, and we get an answer of 10.46. Okay. Then you may be asked to calculate P0. So if that is the case, then the formula for P0, the current price of the stock, is this one. This is the formula for finding the P1 divided by RS minus G. But remember, this RS minus G, that difference is the divisor. So we have to include that in parentheses when we use Excel. Okay, so that goes equals to P0 would be D1, which is the next year's dividend, 0.8 divided by, we start the parentheses so that the difference is calculated first. RS minus G. RS, which is cost of equity, we just calculated it, okay? Minus G, which is 8%, and we close the parentheses and enter it. We get an answer of 32.5. And the given price that was given to us, that was also 32.5. We get the same price because we're using the same data, right? It's the same information. So and we got this cost of equity from the same information. So we're gonna have the same price. Okay.
Quick
Now,
question. If why don't you use parentheses in the cost of equity formula? You're also dividing, so the P0 plus G is not in a parenthesis. Just
okay, yeah, good question. Very good question. Now, what is the problem here? If you don't use the parentheses, what Excel does basically, it's the sequence of operations. If you can recall from your high school algebra, let's remove this parentheses. What happens in this case? When
exactly.
I
thought I was supposed to use it every time in NA because you're supposed to do either the divisions first and then you add, or the multiplication first and then you add or subtract, right?
Yeah, you will have to look at the formula. Now, in this case, what it will do is that it will do the division first, okay, and then the G will be subtracted from the answer of the division.
Correct. Yeah.
And if we do that, we're going to get a wrong answer. You see, that comes out to the price comes out to be $756 if we do it that way. You got it?
Yes, but what my question was, why not when you add, but you have to do it when you subtract, right? Because the cost of equity, you have also a division and then an addition.
Okay, good question. So let's do it this way. And let's go back to our formula that we just derived over here. So when we calculate the RS, what we do is that we exchange the P0 with the RS minus G. So this whole RS minus G goes to the left side of the equation, and that P goes to the division with D1. So D1 divided by P0. Now, when we take this G to the other side of the equation, it is in subtraction on the left side. When it goes to the other side, it goes to addition. So what that means is that this division will be done first, D1 by P0, and the G will be
added. Thank you. Yes, thank you very much. This gave me a picture better.
All right. Thank you for asking. I mean, if there's any like those smaller confusions, you may know the formula and you'd be thinking you're doing it right, but you get the wrong answer. So that those might be a smaller mistakes that you just overload. So yeah, if there's any confusion like that, please do ask. All right. So not like that. Let's do this again. And this is not going to be a percentage. This is going to be because this is a price. It's going to be general number. That comes out to be $32.5. Now, if this information, other data is given, and you're asked to find the G, how are you going to do that? It's again, you have to rearrange that formula. So either you write down these formulas with you, and like this is the formula for P0, and this is the formula for RS, if you want to note it down, or if you are good in rearranging the formulas, you can do that right there during your exam. Okay, so how can we find G in this case? If we have to find G, of course, we have to take the D1 by P0 to the other side of the equation, right? And this D1 by P0 is a plus over here. When it goes to the other side, it becomes a minus. So I can rearrange the formula, and that G would be equal to RS, which would already be positive, and minus the D1 by P0. When it goes to the other side of the equation, it becomes minus. So that comes out to be D1 divided by P0. So the formula is RS minus D1 by P0. You got it?
Dr. Shakur, I'm
Mhm.
sorry, on that formula for RS equals D1 divided by P0, is that a minus growth or plus growth? Yeah,
This
thanks.
plus this is a plus growth, plus, because that G was minus over here. That G was minus on the left side. When we take it to the other side,
Okay.
it becomes a plus.
Okay,
Got it?
okay.
So this is the third formula, a third variation that you might be, if it is asking you to calculate the growth in the problem. Okay, so let's do that. If it is asking you to calculate the growth, the formula I have written that for you is RS minus D1 by P0. Now remember, when we do that, it will do the division first, D1 by P0, and then the answer will be subtracted from RS. So equals to RS, which we just calculated, 10.46 minus D1, which is 0.8, and divided by P0, which is 32.5. And we enter it, that comes out to be 8%. The 8% is the growth, and that is the same number that we got here. Reason being that we're using the same data. So we cannot have a different growth with the same data, right? But just giving you the variation. So sometimes they ask you to find P0. Now you know how to do that. It may ask you to find RS, and you can do that. It can ask you to find the growth, and you can do that. And I suppose you can also do if it asks you what will be the next dividend. If it asks you next dividend, what would that be? Can we do that? Can we rearrange the formula? Next dividend, pretty easy. So here you can see this is the initial formula. You can rearrange it. If we have to find D1, that would be equal to, so okay, so D1 would be equal to that this RS minus G, this whole thing, this is in division on this side. When it goes to the other side, it goes to multiplication with P0, right? So that will come out to be P0 multiplied by RS minus G. Now remember that RS minus G is in parentheses, so that subtraction has to be done first, and then the answer will be multiplied with P0. Okay, so and just in case it asks you to find D1, the formula would be equal to P0, which we just calculated, P0 multiplied by bracket start and RS, which is the cost of equity, minus G, which is the growth rate, and parenthesis close. That will be the formula that we use. Let's do it. Equals to P0, which is the current price, 32.5, and multiplied with, we start the parenthesis, and then RS minus G. RS is the cost of equity, 10.46, and minus G, which is 8%. And we close the parenthesis and enter it, and we got 80. No, so this is formatting is wrong. So if we remove that from percentage, it comes out to be 0.8, which is the same answer that we got in the date. Clear? So you can have these 4 different variations to calculate. You got it?
You
Yes,
are
thank you.
recording this, correct?
No, sorry?
You are recording this?
Yes, yeah, it is being recorded. Yes, recording is on. I'll be sending this to you. Okay. And so I will not send the Excel file because I just want you to watch the recording if you are confused. Okay. And do it yourself. If you cannot do it, get back to me before you attempt your exam. So that you understand it, and because during the exam we will be using lockdown browsers, so you will not have access to any other materials. That will be it. All right, now the next kind of problem that you can expect is the weighted average cost of capital. And if you can recall, you also calculated this in your case 2 analysis, right? You calculated WACC. And for the WACC, you had to know the weight of debt and weight of equity and the cost of debt and cost of equity, and you have to know the tax rate. The formula for calculating the weighted average cost of capital, which we call WACC, W-A-C-C, the formula is the weight of debt multiplied by the cost of debt, so that is the RD, rate of debt you can call it, multiplied by 1 minus T. We multiply this with 1 minus T because we get a tax benefit when we borrow money. So that benefit and the interest payment that you make, you get that reduced from your total income, and it reduces your taxes. And then plus weight of equity multiplied by the cost of equity. Okay. If you also have a preferred stock, for example, then you also write weight of the preferred stock multiplied by the cost of the preferred stock. But in this particular case, we have only debt and equity, so that makes things easy. Now, we know that for the WACC, we have this formula. Let's see if we have all the information given to us. So weight of debt is required, and we have that, 60%. Weight of equity is given, that is required in the formula. Cost of debt is required, and we know that, that is given. And cost of equity is also given. And tax rate is also given. So all the values are given. So that means we're good to go. Just plug the values in the formula, and you will get the WACC. Just in case some of these are not given, like for example, in your case, if you can remember, the cost of equity was not given, right? And for that, you had some additional information. You used the KPIM equation to calculate the cost of equity first, and then calculate WACC. But in this particular case, all of the data is given, so only this thing has to be calculated. Let's do it. In the formula, we have the weight of debt, which is 60% in this case, multiplied by the cost of debt, which is 8%, right? Cost of debt is 8%, multiplied by, we start the parenthesis, and we do 1 minus T, where T is the tax rate, and that is 25%. We close the parenthesis and then plus weight of equity, which is 40%, and multiplied by the cost of equity, which is 16%. And we enter it, and we got an answer of 10%. Okay. Now, given this situation, let me ask you a variation of this question. In this particular case, the weight of debt is 60% and the weight of equity 80%. Now, what if we have to increase our equity and reduce our debt? So what we do is that we replace, or let's we replace this weight of equity with the weight of debt, and 40-60 is exchanged. What will happen to the WACC? Will it increase or decrease if we replace 60% of the debt with equity? Will the cost of equity increase or decrease? The cost of weighted average cost of capital. Will this answer increase or decrease? What do you think?
Decrease,
Decrease. And why do you think so?
because I'm guessing.
Uh, okay. Oh, but yeah, still, I mean, what we're doing here, look at this. The cost of equity is 16% and the cost of debt is 8%. So obviously equity is expensive and debt is cheaper, right? And what we're doing is that we are replacing the cheaper thing with an expensive thing, right? So the overall cost is going to go up.
Right.
Make sense? So let's do that. Let's make this 40 as 60, like the equity is 60, and we make that weight of debt as 40, so that the total is 100. The total cannot be more than 100%, right? You see, the WACC went up to 12%. From 10%, it went up to 12%. You know what I mean?
Yes, thank you.
Yeah. And verbal variation of the problem could be something like this. By how much will the cost of equity change if we replace 20% of the debt with 20% of equity, like as we did before? So we know that the previous cost of equity, weighted cost of capital, was 10%. And when we did that exchange, we exchanged the cost of equity, the weight of equity with the weight of debt. Then the new weighted average cost of capital is 12%. So obviously that difference is an increase of 2%. 12% minus 10%. The weighted average cost of capital changed by 2%. Increased by 2%, you would say, right? What if we change it again? Like, what if we make both of them 50-50? What will happen to the weighted average cost of capital? Well, currently it is 12%. What will happen to this? We make them both 50-50.
It will go down a little bit.
Exactly, because we will be getting rid of 10% of the equity, which is expensive, and we will be replacing that with debt, which is cheaper, right? So if we make
Correct.
both of them 50-50, then the weighted average cost of capital went down to 11%, you see? And the difference is a 1%. So if you understand the logic, there might be some variations of the problems that you can expect, but should not be a difficult thing to understand and digest. Got it?
Yes.
All right. Now, the next kind of problem that you might be expecting is the NPV, net present value. You also did that in your case analysis. So those of you who were actively involved in that case would be pretty good in understanding these problems. Okay, now you would be given a problem, something like this, that we have the weighted average cost of capital 8% or whatever, 12%, 10%, okay? And we are making an investment in a new project, and that initial investment at time 0 is minus 1,000. That means we are investing, it's a cash outflow. And then we start receiving this money. in up to 6 years, 150 in the first year and 400 and then 500, and that goes on. Okay. The question would be, calculate the NPV. What is the NPV of the project? NPV basically means net present value. Now this $1,000 is already in the present because it is at time 0. But these other cash flows are not in the present because they are taking place in the future. What we need to do is to find their present values. Okay. And for finding the present values, we use this formula. If you can recall that from your chapter 5, okay, there's a bracket. Let me write that down for you here as well. So it would be present value is equal to future value, whatever is the future value, divided by bracket divided by 1 plus R, where R is the interest rate or the cost of capital or the WACC or cost of equity, whatever is relevant in that particular formula. And this is raised to the power n. Okay. So we'll be using that formula to find the present values of all of these. Okay. Now, if you can recall, when we had the session in the class, about the case analysis, I calculated this NPV for you, and you have already done that. And if you can recall, I use this formula equals to NPV, and we start the parentheses, we give it the rate, the discount rate that we're going to use. In this case, we're going to use this WACC. In comma, it is asking for the values. Remember that we will be using the values starting from the first year, not the year 0 value when we use the Excel formula. So I select all of those values. Okay, I close the parenthesis, and then in this initial cash flow of 1,000 is added back. So added next. So plus the initial investment, whatever that might be. So you can use this Excel formula to do this. And that comes out to be, now this is not a percentage, let's change the format. That comes out to be 594, okay? Or 595 is the NPV in this case. And NPV, net present value, is positive. So it can ask you the question, should you accept this project or not? Based on the NPV. When the NPV is positive, we accept the project. When it is negative, we reject the project. It can also, if you don't know this formula, you will have to find the present values of all of these and then add them together to find the total net present value. The way we're going to do that is to build this formula equals to, we will take the future value divided by, start the parenthesis, 1 plus R, which is 8% in this case, close the parenthesis, and this is raised to the power n. And for this $1,000, n is 0. This is already in the present. Okay. Now what I'm going to do is that when I use this C43, which is the variable, the cell reference for the rate, I want to use the same rate for all of these calculations. So when I'm there, I just press the F4 button, and you can see that the $ appears before and after this, the column reference. That means that when I drag the formula, this interest rate or the WACC reference will not be changed. I enter that, it gives me the same answer because this 1,000 is already in the present. But when I drag it to the right, okay, it gives me the values of the other variable, the other present values of the other future values as well. And you can see we get these values. Now look, if I click on any of these, double click, you see it is using the 400, and that 400 is discounted for 2 years because it takes place in 2 years. And it uses the same 8% interest rate because when I was building the formula, I pressed the F4, so that reference will not change no matter where I drag it. Okay. Now, in order to calculate the NPV, I simply sum. Now, all of these values are already present values, right? So I simply find the total sum of these values, okay? And that comes out to be the NPV. And again, that format has to be changed. And you can see that it is the same number as we got with the Excel formula, 595 in both cases. So you can use the Excel function the way I told you, or you can use your calculator. If you have to use your calculator, then that each of these have to be done one by one, and that will be a little bit longer, but you can also use your functions in the calculator. But I suggest that you use Excel. Clear?
Yes, thank you.
All right. Now, next, the payback period. You also did this in your case. Now, for the payback period, like let's say that it is asking, this is the same cash flows, the same project. And the question asks us to find the payback period. So we have already done, noted the values. For the payback period, we need the cumulative cash flows. I have already done that here, but let me remove this, okay? So we have to find the cumulative cash flows. Now, in the first year, of course, the cumulative cash flow is minus 1,000 because that was just what went out from us, and we have a cumulatively we're negative by $1,000. Now, when 1 year passes, we receive 150. So that means we got some money back, and our cumulative cash flow will go down a little bit. So we take the previous cumulative cash flow and we add the next cash flow, which is 150 with it. Now we are $850 short. So we recovered some money from our initial investment. And when I drag this to the right, it does the same process. And now you can see that the sign changes from minus to plus between like from year 2 to 3. That means in this year, like in year 3, that is where we have already recovered our total investment. Okay. But we don't know like exactly when. It is somewhere between year 2 and somewhere in year 3, right? Okay. 2 point something. The formula that we use for the payback period is this. We use the year before recovery. And you can see like in this year 2, we're still negative. So this is the year before recovery. And year 3 is the recovery period, right? So the year before recovery, which is year number 2, plus the uncollected amount before the recovery period. So this 450 is still unrecovered before the recovery period. And then we divide that by the cash flows during the recovery period. How much is the cash flow during the recovery period? Remember, the recovery period is year 3, so that is 500. We divide it by 500. So let's build the formula using Excel, or you can use your calculator. So we write that down, year before recovery. Now, in this case, we know that year before recovery is year number 2, plus uncollected amount before the recovery period. That is 450. Now we have to ignore the negative sign. Remember that. Okay. So we simply write down the 450. Okay. And then divided by the cash flow during the recovery period. So we have a cash flow of 500 during the recovery period. And when we do that, we get a value of 2.9. So that means we get our money back in about 2.9 years. Almost 3 years, right? Close to 3 years. Like, you know, in the third year, you can see like we just had like $50 or positive cash flow. That means like we just got that towards the end of the year. Okay. Now, if it is asking you to find the discounted payback period, here it is, discounted payback period. What we need to do is to find the discounted cash flows, which are basically these values that we just calculated. And then we find the cumulative discounted cash flows, So we do the same process that we did in this row, but using the discounted cash flows. Make sense? So let's find the cumulative discounted cash flows. Of course, in year one, the cumulative discounted cash flow is minus 1,000. In the next year, we take the previous cumulative cash flow and we add the current year's cash flow with it, which is 139. Remember, now we are using the discounted values, not the actual, the accounting cash flows. And enter it, and then I drag it to the right, okay? And it gives me these values. Now you can see that the sign changes from negative to positive in year 4. You see that? Which means that the payback period, discounted payback period, is 3 point something. Okay, the year before recovery is year 3. Okay, and uncollected amount before recovery is minus 121. So that is 121 we're going to use in the formula. And cash flows during the recovery period, we know the recovery period is year 4, and the discounted cash flow is 257 in that case. Let's use those values equal to year before recovery. We know that it is year number 3 plus uncollected amount before recovery, which is 121, but we have to ignore the negative sign, remember. So what I can do, I can just simply type that 121, or you can put a negative with it and it will change it to positive if you want to use the cell reference. But let's do it this way: 121 divided by the cash flow during the recovery period. Recovery period is year 4, and we have a cash flow of 257 over there. We do that, and the discounted payback period is 3.47 years. Okay, so that would be another variation of problems that you can expect. All right. Now, so this is also the constant dividend growth model type of equations, but in this particular case, we are not given the D1, they have given us D0. Okay, so if we know the dividend growth, we can calculate D1, right? This is the formula, right? D1. Okay, how can we calculate D1? Of course, D1, if you're not given D1, D1 would be equal to D0, which is the last dividend, and multiplied by 1 plus G in parentheses. That means we give it 1 growth, and that would be the next dividend, right? That would be equal to D1. So just in case you are given D0, you can use this formula to calculate D1, right? So D1 would basically be equal to D0 multiplied by bracket start 1 plus growth rate. Okay. So not this one. So we are required to calculate D1, the next dividend, and this is going to be equal to D0, which is 1.5. And okay, so this data is not sufficient. We have to know the growth rate as well, which is G. And just imagine like it's 5%. Okay, so D1 would be equal to D0, which is $1.5, multiplied by bracket start 1 plus G, which is 5%. Okay. And let's say that we are required to calculate the price. Let's say that that's not given. So let's say price, or we call that P0. Okay. So price is we know the formula for calculating the price is equal to D1 divided by bracket start RS minus G. Okay, so let's use that formula equals to, we just calculated D1, which is this one, and divided by bracket start RS 12% minus G, which is 5%. We close the parenthesis and we get 22.5. That is the price of the stock. So just in case that D1 is not given to you, you know that you can calculate D1 if it is not given. All right. So that's the majority of it, but please don't expect that it's going to be, all the problems are going to be exactly like this. There will be some true false, there will be some like more conceptual variations of problems and stuff like that. You can also expect a problem where you are asked to calculate the, for example, the, what is it? The net operating working capital. Okay, so let's say that the problem gives you the operating assets. Let's say $5,000 in operating assets, and then operating liabilities, operating current assets. Current assets and operating current liabilities. Let's say that is 3,000. Then the question would be, what is the net operating working capital? So that is basically the difference between the operating current assets minus the operating current liabilities. That's a big number, but this should not be such a big, so that is 5,000. So we have 2,000 in operating current liabilities. Let's say that if you are given a problem in the current liabilities, they say there's a note payable, which is like a borrowing from the bank, and you pay interest on that. That borrowing is basically not included in the operating assets. So you won't have to include borrowing in the operating assets. Similarly, if you are given cash and there's a big cash, so a lot of that cash is not involved in the operating, in the operations, so you would like to remove that cash as well. But if the problem says that the cash and all the current assets are in operations, then that means those are operating current assets. If it also says that all the current liabilities are in operations, then those are the current operating liabilities. But if there are some notes payables, like a borrowing from the bank, and it obviously is not an operating asset, so you will have to remove that and include the other liabilities in the calculations. I think, and so this is like just a you know, as I said, some of the kind of problems that you can expect. But don't just restrict yourself to this. You have to go through all the materials involved and try to understand everything. There will be some other problems and questions as well.
Dr.
Heather?
Shakur, are you going to provide the Excel sheet and we type everything that you've done, or some of the information going to be already on an Excel sheet that you provide?
So I will provide a blank Excel sheet. Okay. There will be nothing in it. Now, that is your task to read the question, extract the information, and then do the calculations.
Okay,
And yeah, and I have given you enough time to do these calculations, like, with peace of mind. But I would strongly encourage you to um, look at similar problems at the end of your chapters, some sample questions like these, try to extract that information and do the calculations yourself, do some practice. If you understand these problems that we just did today, you are good, like, about 80% of the exam, or 80% of the exam. So
and
that,
we
that
have
would-
one attempt for the exam?
yes, 1 attempt.
Okay,
Just in case you get into any technical problems, something like that, just let me know so that we can resolve it. Another thing which is important to know, that when you start your exam, some students say, like, the Excel file is the link is given, and you can see that even before you start your exam. But if you click on the link, the Excel file will not open it, and then you send me emails, hey, the Excel is not opening. Excel will open only when you start your lockdown browser. Okay? Then you can click on that link and it will open up for you. When it does open, the first sheet that you would see, probably you will see only one cell in that first sheet. The rest there will be nothing. So I would recommend that if that happens, you just start a new tab with this plus sign over here, and a new complete empty sheet will open, and you can start working in there.
and
But I
typing like similar to what you've done.
Yes, exactly.
Okay.
But it will be completely empty sheet. There will be nothing in there. It's up to you what you write in it.
Well, in the last exam, none of the top, like, let's say the conditional formatting or the percentage or dollar, none of that was on the Excel sheet. It was like this, it did not exist, that top part of the page. Like the
Sorry.
home, I mean, you could go to the home and insert, but there were very few options in it. They were not like this Excel sheet that we're seeing right now, where you can
Oh,
see.
okay. The formatting, yeah, it is very limited. So and you, by the way, you don't need those formatting, So I just did this just for you to see, like, what is
Yeah.
required.
I was trying
And
to like adjust the number of decimals in it and I couldn't find it. So while I was doing it, so that's why I mentioned it.
I see. But yeah, I mean, like, even if it's a long number, like, let's say it's something like this, many decimals with it, like something like that. You understand what that is. But anyway, if it is something like, it does not type a formula for you or something like that, just let me know and we will talk about it. But it should be good enough to provide the space for you to do these calculations. Or if not, I mean, like, a lot of these problems can be done using your calculator as well. Like, for example, this one, you don't need to do it in Excel. You can just write those down on a piece of paper, these values, and simply do RF plus beta into RM minus RF, and that would be pretty easy with a calculator and a pen and paper, instead of typing those values in your lockdown browser, within the lockdown browser, and using Excel. So if you think something can be done with your calculator more easily, then that would be a better thing to do. Up to you. Any other question?
No, I'm gonna go through this when you release the recording, go over it and over it. If I have any
Sure.
questions before I start the exam, I'll quickly email you.
Sure.
But
If
this
there's any
should
problem,
help.
yeah, this will be helpful. Just do practice. I mean, try to understand, do a number of variations of these problems so that you're clear. You're confident that you can do it yourself and you can do different variations. All right.
Okay,
All right, then. Thank you very much. And I'm looking forward to your exams. It is starting tomorrow, like in other words, tonight at 12.
thank you, Dr. Shakur.
Thank
Mhm.
you.
Thank you. This was very helpful.
Thank you.
You're always welcome. You're always welcome. If there's any problem other than this, just let me know. Just shoot me an email. All right.
Okay,
All right. Good night.
good night.
Thank you and have a good night. Bye-bye.